Volkswagen shares have ended the day lower after it said more cost-cutting is needed to revive profit margins. VW is also struggling with lower than expected demand for EVs, as well as supply chain issues and rising costs. The car maker says it'll prolong sales of combustion models to compensate. BMW has warned that EU tariffs on Chinese electric vehicles are damaging European car makers. The German manufacturer reported a lower than expected profit margin in the second quarter as demand fell in China and competition grew. The shares have closed down 3%. Toyota has reported a 17% rise in first quarter profit as the weaker yen helped offset lower sales and production. Operating profit for the 3 months to June hit $8.7 billion, in line with estimates, but it was the weakest growth in 7 quarters. The shares are down more than 8% on that news. Well, let's talk now to David Bailey, Professor of Business Economics at Birmingham Business School in the UK. David, welcome back. Good to see you. Well, let's bang through these results. Let's first start with Volkswagen and your reaction to those numbers.
Yeah, very disappointing. You summarised it very well there. So weak sales, particularly in China, where sales are down by almost 20% year on year. Huge price war taking place in China, and the German premium manufacturers are simply unable to cope with that. So that's a big hit. We also saw weaker than expected electric vehicle sales in Europe, hence that comment about prolonging the internal combustion engine. On top of that, huge restructuring costs as they're trying to take out capacity to get costs down. Now, what's interesting is the profit figures are actually very disappointing given that, and the CEO has said that that cost-cutting will have to continue further. That implies more in the way of redundancy costs, possibly plant closures going forward.
Let's look at BMW, because it's interesting, isn't it, how European and US regulators are imposing tariffs to try and keep Chinese EVs out of their markets, and then you have BMW warning that tariffs are damaging them.
Yeah, so very split views within the European auto industry about the usefulness of tariffs. One view is it buys a bit of time for the European players to catch up with Chinese automakers who have been at this for nearly 25 years, have a massive cost advantage, huge scale, and can simply outcompete the Europeans. On the other hand, you've got the likes of BMW and also Volkswagen saying, hang on a minute, we sell a lot of cars into China, we're going to get hit with retaliatory tariffs, and also a lot of the inputs coming into European electric vehicles come from China. So very mixed views on it, and certainly I think BMW and Volkswagen are the car companies in Europe most exposed to tariffs and a possible trade war.
Toyota's a complex set of numbers, isn't it? Just talk us through that.
It is a complex set. I mean, it's very interesting. They've gone obviously down a very different strategy. They've positioned themselves very well in terms of hybrid vehicles. So they're taking a much longer game as compared to some other car makers who are going electric very quickly. So in that sense, they've been well positioned. They've also benefited from exchange rate shifts, which means once they report that back into Japan, actually that looks pretty good. But just like BMW and Volkswagen and others, they're seeing the Chinese challenge, and because of that, their sales are starting to be hit. So they're in a better position, but they face similar challenges long term.
David, good to see you. Thank you for that. David Bailey, Professor of Business Economics at Birmingham Business School.